Hello and welcome to another video. Today we're going to be going over a few things, but first and foremost, my name is Victory Trades, aka Quaker the Dream Maker, aka Dream Maker. However you want to go ahead and put it, just remember to go ahead and put some respect on my name. Anyways, the purpose of this video is to help the people that claim that they want to dive into day trading but either don't have the time to do it, don't have the confidence to do it, or just have another reasoning beyond just not wanting to do it. Now, if it's the last reasoning, then good. This video isn't for you and you're not going to watch it all the way through. But if it's for the first two reasonings, then this is for the people that say that they want to do it but yet haven't really put in the effort to try. Or maybe you guys have and you guys have carried away with your own journey, and if that be the case, hats off to you. I would take my hat off, but nobody wants to see that atrocity that lies underneath. Nobody wants to see that. I went ahead and formulated a good little breakdown of what this is going to be. I set it off into different sections. The goal to this is to help those people in that want to become profitable or want to become a trader in the right direction into becoming the right trader. Now, you don't have to look at me for advice, nor should you use me as financial advice, but this, for what I'm doing, is just showing you what I would do in a certain trade and how to execute it the way that I would. You don't have to do it the way that I do, but I would say that you would use the same principles. Or don't. However you want to do it, but this is just the way that I would prefer that you guys do it. Anywhoosies, the goal to this is to help you guys get better. And it also to help me get a good little following behind this, because when I first started off about a year ago, I didn't have much of anybody. This was all me by myself. Me, myself, and a computer. I went ahead and I didn't dive deep into day trading all straight through. I had a lot of distractions. But once I stopped indulging in those said distractions, I found myself getting 1% better, 2% better, 3% better than the day that I did prior, the week that I did prior, the month that I did prior. And it showed in all the things that I was doing. But I didn't have friends to do this with, and the friends that I did talk to at the time were more interested in gaming or had their own different shit that they were going through. So I was all by my lonesome. For the people that are looking to go ahead and get into this, I don't want you to be lonely. I want to be able to build a community that helps one another with a positive mindset and positive morals. I just want to be able to help the next set of people coming into this industry and be a better mentor than half of these other people out there. There are good mentors and there are bad mentors. I've ran into both sets. It is after Thanksgiving, so everybody's here. You're going to be hearing a lot of chit chat, a lot of baby, a lot of woo wah woo, but that's okay. You get the realness of what the situation is. You get the live. You get the realness. I do have a set of notes that I have set to the side, bulletins more or less, so that way I stay on track with this. You guys also have the set of notes and the set of bulletins that I have set for you guys right there in front of you. What I would like you guys to go ahead and do, and if you guys are really serious about this, is take fucking notes. Now, this is a recording, so you guys are able to look back on this as many times as you want, but to save you time and a little bit of headache, the best thing for you to do right now is to run and get a piece of paper, notepad, piece of paper, write this shit down. Write down everything that I am about to tell you, because it's worthwhile. It's worth fucking while. Now, a little bit of background for me is about a year ago, all I really was content with was just door dashing, Instacarting, playing video games, smoking weed. That's it. I didn't have any other future goals. I didn't have any other aspirations. Okay, lies. I had aspirations and I had goals, and that was to be a YouTuber. But, well, gaming was fun and all. Not to say that I failed, I just didn't really put in the right amount of effort to see any kind of growth from it. Had my own reasonings for not putting in the effort, but here I stand with the proper time and the proper knowledge for YouTube that I can be using with teaching you guys how to day trade. And also applying how to make videos and this, that, and the third to make things right. I didn't get into day trading about a year ago, to be completely honest with you. This all happened, and this all started back when I was in high school. I had a teacher show me the ropes when I was in economics class. He taught his students just the bare bones of market structure, and at that time it was support and resistance. I fell in love with it. I didn't keep that adventure going only because back then it was a little bit harder to get into the industry. The software wasn't free. It kind of costed an arm and a fucking leg, and I didn't have a computer to even think about taking on that software or even wanting to purchase the software to even begin with. So that endeavor just gone. That passion gone. 15 years, 16 years down the line, I'm seeing 22-year-olds make a killing on YouTube when it comes to day trading. So that kind of just sparked the flame once more, and I continued down the rabbit hole with all the knowledge that I had back then and all the knowledge that I've acquired within the last year to be where I am now. I want to state this now, though, and I want to put it out there full front, face forward, ass in face. I am not a perfectionist. I am not even close to where I want to be when it comes to this shit. But I am on the right track. I am showing myself consistent results to be confident enough to say I am ready to share with you guys what I've learned and not have it bite me on the ass. I wanted to do this so bad, so fast, but the reality of it is, if I didn't understand the confluence, if I didn't understand my rules, if I couldn't stick to my rules for a long extended amount of period of time, how the fuck am I going to be able to explain it to you guys to have it make sense? I needed to replicate what I know on a day-to-day basis in a positive way, no matter if I won a trade or if I lost a trade. Like I'll explain that theory later, but I needed confidence to know that I'm doing the right thing over and 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 over again. Here I stand with that said confidence and knowledge to be ready to give to you guys. To the people that are willing to go ahead and take this and run off with it. So, enough yapping, enough chit chatting. I'm gonna go through what the 3 basic pillars are for day trading, and the 3 pillars that I follow on a day-to-day basis to keep my account alive and to continuously put in more money into the account so that way I pass that challenge. Now, what are the 3 pillars? 3 pillars are simply just... The 3 pillars are having an edge, having good psychology, and having good risk management. Without those three, your account, your capital will never be secured. You will always find yourself in some really bad situations, and hell, even worse, your confidence just gone out the window because you don't have or follow those 3 pillars. There's gonna be when you start going deeper into the rabbit hole of day trading, you will find that the majority of profitable traders follow these 3 pillars in some way, shape, or form. They follow it. They might label it in a whole different fashion, but at the end of the day, they still have an edge that helps them win a trade. They have good mindset when they are in the trade, and they have good risk management. During day, they know how much money they're willing to risk, and they're okay with that. You'll see that pattern with every other good trader. I've seen that pattern with a lot of good profitable traders. They will preach those 3 pillars, those 3 common factors over and over and over and over again. And I assure you not, I promise you this. If you take the time after this video, if you take the time to go venture off deeper into the rabbit hole, you'll find at least 3 to 5 traders that have that same mindset, that follow the same rules. Come back to me with some real sound advice about how people Come back to me with solid advice about how those traders don't follow that advice, and I'll give you $10. Challenge on the table. But at the end of the day, majority of good profitable traders that stay alive and have good confidence because of good risk management, edge, and psychology are the ones that do ultimately survive. Away with that. No more of that. But still important enough. Having those three pillars. So again, for the people that are not writing this shit down and want to catch up, edge, good psychology, and risk management are the 3 pillars of trading that you need to go ahead and get comfortable with and just accept. Now, we went over edge. Edge is just okay, so actually we didn't go over what the 3 pillars are in definite. Having an edge is step 1. Having a strategy, knowing what to do and what not to do. Having rules, having a set of rules is 1. Number 2, good psychology. Good psychology entails having good emotions when you're in the trade, having no emotions when you're in the trade, and being able to have this grit about you to continue on when you don't even want to. Because there's going to be a lot of times when you're, like I've mentioned before, your confidence is going to be shaken if you don't have a good risk management. If you don't have good risk management or an edge. And Sometimes in the beginning of your journey, you're going to fall into one of those three traps, but you're going to have to work your way out of those traps to make those other setups, risk management, psychology, or risk or edge, a lot better for you to understand. Put it simply, if you have your edge and you understand your edge, but your mindset is a little fucky and that's what's causing you to lose money, you know what you need to fix. Step one of the process of, of the three pillars is done. What you need to do now is the second process of the pillar is psychology. You now need to go ahead and worry about your where you are mentally in the trade, how you're feeling in the trade. And the best way to do that is to I dropped you guys. Is to have a journal. Is to write down everything in a fucking journal. I was really like, what? How does that help? Well, the way that it helps is you're able to go. Not only does it help you be more self-aware, it will be able to be used to look back on and define where you went wrong and where you went right. That also equals out to more confidence and better confidence to be added on. After you've solved your psychology, risk management is going to be easy for you. It would be so easy for you because you've developed the discipline, you've developed the patience in the psychology portion to know and to have the patience for and the acceptance for how much risk you're going to lose or how much risk you're going to enter in with, period. So in hindsight, what I'm trying to do is just wrap around to the third section. The third section of the pillar is risk management. After you have a good psychology, you're also going to be the risk management. Like I said, is going to be a walk in the park. You're going to have You're going to have enough discipline to enter into the trade every single time with the exact same amount of money that you're willing to go ahead and lose. Because if you're not comfortable with that exact same amount of money that you're going into the market with, there's a lot of fear and a lot of negative emotion that will be tied into it that you don't want to be a part of. You don't want to be a part of. At first, you will be a part of it. You will most definitely be a part of that learning curve in the beginning, but what you want to do is teach your way out of it. But we'll go through the level of success and how to navigate the roadmap to success. Those are the three pillars that you need to develop. You need to develop an edge. You need to develop a good mindset, good discipline, good patience. You need to develop a good risk tolerance, and also with the risk tolerance, you need to have discipline every single time to enter in with that trade with the same amount of money, depending on how confident you are at first. But if you're a beginner, your goal is to only risk just one amount, $50, $80, and enter into the trade with that every single fucking time. And not only that, but I forgot to tie in one thing with risk management. Risk management isn't just how much money you're willing to risk. Risk management is also understanding how many trades you're willing to take a day. Me personally, because if you don't have that last part tied into risk management, you're going to be taking more trades and entering in with more money and losing more trades, equaling out to more losses. So with me, how do I evade that? I try my best to stick to 2 to 3 trades a day. There's a lot of times I don't even take the third trade. There's a lot of times I don't even take the second trade. More times than not, I'm comfortable with the fucking one trade. There's a certain amount of money that I could only make in a day, which caps the level that I could go to. But nonetheless, it teaches me good risk management and how much money I'm willing to risk. You want to be at that level, and eventually you will be at that level. But you need to learn to be consistent with the same amount of trades that you take every single day, tied in with the amount of money that you're willing to lose on a day-to-day basis. Once you have those 2 factors tied in, risk management, done. 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 Once we get the 3 pillars down and set in motion, we are able to continue on with the understanding and the teachings. Something that you need to understand and comprehend is that we work off of probability. There's a lot of fucking times we're wrong, and that's okay. If you cannot accept the fact that you're wrong, you're gonna have a hard time in this motherfucker. You're gonna have a hard time in this bitch. Having those 3 pillars at first help you understand and be more confident and comfortable with saying, I am wrong. Or I'm right. It determines where you go wrong and it determines where you go right. We got a little bit of company over here. What's up, pretty lady?
I'm doing nothing. I didn't bother you.
No, you're not. You're perfectly okay. We work off of probability. Having good edge, having good risk management, having good risk management and having a good mindset helps us understand and go forth with trades even better than we would without that type of knowledge and falling into a trap of being right all the time and that losing confidence. Because if you don't have the 3 pillars in mind and aren't willing to execute those 3 pillars, you're going to walk into every single trade thinking, this is it, I'm going to win. And there's going to be some times that you do. There's going to be some times that you do get lucky back to back. But what you want to do as a trader is depict where the market is going on a day-to-day basis and have it be right on a day-to-day basis. There's gonna be times when you're wrong and you gotta accept that, like you said. But the ultimate goal for a trader isn't to just make money, because that's the last thing. But the ultimate goal for a day trader is to predict where the market is going in with a high probability, and it playing out. That is the only goal for us. It's not to make money. The making money from this is the result from the understanding of the 3 pillars, and executing those 3 pillars in the right way is the only way that you're ever going to be profitable and get rich off of this shit in a consistent way.
Okay.
Now that we have the understanding that this is all just probability and we need to be comfortable with the fact that we're going to be wrong sometimes, we can move on to the next few sections of this. What you see in front of you, actually, I'm going to go take a piss. We're going to go over... Actually, hold on. All right, sorry about that. All right, go ahead and let the willy loose for a second. Now that we have the three pillars understood, written down to look back on, we can continue on with this lecture. The next part to this is the understanding to what a market chart is. There are two ways that I can properly explain how to read a chart. There are multiple different ways out there that you can use to read a chart. But the way that how I'm about to explain it to you guys is the exact same way that I would explain it to my children. All right? So, the market is the way to read a chart is by two ways. One way is there are buyers and there are sellers. There's always going to be buyers and there's always going to be sellers. There's always going to be people out there willing to buy, and there's going to be people out there always willing to sell. With those two in mind, we can move on to the next point. The next point of this is one of those two are always going to be stronger than the other, or they're going to be equal. I'm going to stop it right there because I would make the explanation even worse. Not even worse, but harder to understand. With understanding that there are buyers and sellers in the market, we can also go ahead and understand that there is a communication to be had between those two people. And that is represented by sellers or buyers. Long red candles or long green candles or short green candles or short red candles. What you see is communication between buyers and sellers. If you see a large red candle and a small green candle after the red candle, that would usually mean that the sellers are more in control of the conversation at that point. Where if you were to see a large green candle and a small red candle, you will then have an understanding that the buyers might potentially be in control of the conversation. At the end of the day, what we would want to see is one of those two. About to lead in. I'm about to go into one of the confluences, but if your bias for the day is bearish, what you want to do is see price go down for the day. That is ultimately what you want to see if your bias is bearish. Now, if your bias is bullish, you're looking for the opposite. You're looking for buyers to be more in control. The second way of explaining this is there's a battle to be had between buyers and sellers. Normally, there's going to be a power struggle. You're going to see buyers in control, or you're going to see sellers in control. Again, the principle of the matter is that you want to be able to see one of those two parties being played out, and they will be played out. That is the simplest way that I could explain what a market chart is. And just the bare bones explanation on how to read it. Alright? here comes my favorite part of this whole thing, because I truly believe without the three pillars and without a roadmap to success, or understanding the roadmap to success, it would be harder for anybody to achieve their goal in the way that they want to achieve it. Learning, before I continue on, I'm going to go ahead and smoke this really quick. Learning something new for the very first time takes a lot of patience, it takes a lot of knowledge, and it takes a lot of represent it takes a lot of repetition. It takes a lot of repetition, it takes a lot of time, and it takes a lot of effort to get it right. Without knowing where you lie on your roadmap to success, you're always going to find yourself. Okay, well, with that first example set, I'm going to lead into the second example, and that is, if you don't learn from the first fuck up on the learning curve, you'll find yourself in a ditch. So what I mean by that is such. Say you're here, this is the start, this is the beginning of it, you are fresh, you're new, you're ready to go, car's warming up, car's ready to go, right? Your end goal is here, of course. When you're first starting off, what you want to do, when you're first starting off, is going to be easy. It's going to be smooth sailing. It's going to feel as if, again, it's easy. But once you get to your learning curve, right here, you have two options. Two things are going to happen. You're going to use, the first option is you're going to use what you learned in your first straightforward run and comprehend and apply what you learned the right way to help you into the second learning curve. Or the second option is going to happen is you're going to have trouble with this first straightforward run, get to your learning curve, and then fall into the ditch. And then find yourself coming back to the starting point, relearning this shit to then apply it again to hopefully get yourself into the second learning curve, the second pillar of trading, to then hopefully learn this pillar, use this straight run, learn all this knowledge to get to this learning curve, to repeat the cycle. Or you're going to repeat the same cycle, the negative cycle, where you're going to learn this learning curve, or you're not going to learn much in this learning curve, and you're going to find yourself in this ditch, come back to this learning curve, learn it all over again, and either fall back in the ditch or continue on forward. Two things are going to happen. You're either going to learn from your mistakes, or you're not. And that's okay. That is okay. I'm not expecting you to learn this shit. I'm not expecting you to learn this shit outright. It took me a whole year to understand what day trading is and do it the right way. So for me to sit here and tell you and expect you to know what this is just right after this video is going to be some bullshit. You're going to face your learning curve. You're going to have two options. You're going to learn from it or you're going to fail from it. But But what you're going to have to fucking do at the end of it is either, no, to continue on in the right path, what you're going to have to do is learn to have the grit to continue on further, just to continue. Because learning, getting to these learning curves and failing is going to test your patience, and it's going to test your confidence in this shit. You're gonna think to yourself, "Oh my god, like why the fuck am I not getting this? Like this isn't working. This is a fucking scam." To get yourself out of that mindset, you can either rely on the back testing that you've done to show you the results work, or
Go ahead.
you can go back on your mentor's videos and watch him win as much money as he possibly can by carrying out the trades the proper way with the understanding of the three pillars of trading. That's what I do. That is what I do. What I do to get myself out of that funky ass mindset is to go back to my mentor's trades and watch him score eight $400,000 trades, $100,000 trades using the exact same setup as I am. The only difference between his win and my win was the psychology that I applied. The second pillar that he applied his second pillar differently than I applied my second pillar. He used his psychology better than I used my psychology. Or he used his setup. He used his setup 10 times better than I used his setup, which resulted in him having better confidence, better understanding to the second pillar, and applying that second pillar better than I did to where I fucked up. But while watching him overcome the fuck up and I can learn from that fuck up, it then gives me the confidence to know that it works. I can use the knowledge that I've learned to get better, to overcome the learning curve. To then continue on, learn what I need to learn, to not end up in that fucking ditch. He's fine. I've been watching him. Very simple, very easy. The roadmap to success is going to be daunting, is going to be hard, but if you can learn from your mistakes, you're going to be better off than the person that wants to start here and jump all the way to the finish and think that this shit is a scam. You're going to be 10 times better off than that person if you go ahead and actually follow this road. The road is going to be daunting. The road sometimes is going to seem like it's easy. Sometimes you're going to run out of gas in the middle of the road. But your goal, and what I would hope that you do, is stay stead focused on this goal to get you where you need to be. No matter what happens here, the mindset is no matter what happens in this road, I will eventually cross this to get to where I need to be. But you're not going to be able to do that unless you have the grit, unless you follow the three pillars of trading and have the confidence, discipline, and fucking nerve to stay in this shit. I kind of ranted at the end, but you fucking get it. You fucking get it. That is the explanation for the roadmap to success and how to migrate it the right way and what you need to migrate it. And on top of that, the extra sauce to that is how to get yourself out of the funky ass mindset you'll find yourself in the beginning to help you catapult yourself out of the funky ass shit. Oh, you guys are getting fucking sauce. You guys are getting fucking sauce. All right. Here's my other favorite part of the explanation. And there is a difference between given the bag versus getting the bag. I've received more handouts in my lifetime to know that that feeling doesn't sit well with me anymore. I've gotten to the point of my life where, and this is not saying that I've just realized this shit, like, oh my god, I've had an epiphany. Like, no, this is something that I've carried true for a very long, extended amount of time, but am now willing to just openly speak about it for others to comprehend it. Getting handouts only lasts for a certain amount of time, and what I mean by that is the person that you're getting the handout from will eventually run out of the steam or run out of the money and won't be able to help you anymore. And then you're either left to repeat the same process that landed you in the financial situation that you're in, or you can work for what you fucking need. You can work for what you need, or you could learn a fucking skill that could multiply the money for you in the long run. I thought that multiplying my money in the long run would be better off. I'd be able to do that by making YouTube videos and doing gaming. That's the way that I thought that I could multiply my money. Not to say that I gave up on it, but that isn't going to make me money right here, right now. What I've learned within the past year was that if I put my head down for 6 months, put away the distractions, put away the bullshit, actually sit down for 6 months, bang my fucking head against the wall to learn something, and apply myself all the way through, no matter what, it would actually work out. I did that with trading. Although it isn't going to be making me money right now, my mindset is if I learn this skill today, if I can learn this skill within the next 6 months, fucking year, if I can just continue on pushing through and learning as much as I could fucking learn and applying what I am learning on a daily fucking basis, I will eventually meet my fucking goal. I will be able to then have a skill that multiplies my money tenfold. Right now, what I have to do when you get to this stage, what you're gonna have to do and be comfortable with fucking doing is learning to do something without getting paid for it for a long extended amount of time and be okay with it. I grew comfortable with that feeling when it came to making YouTube videos and streaming for YouTube videos and this, that, and the third. I gained that kind of comfortableness with not being paid for my progress by those videos and editing and just seeming like it's wasting my time. Like I said before, going through that time and phase really helps me when it comes to fucking trading. It helps me with trading 10 fucking fold. Everything that I've learned with that, I'm applying to this. I'm making a fucking YouTube video right now while I'm trying to explain this shit. I've grown comfortable with the idea of not being able to make the money that I need to make right now, but in the near future, being able to have the skill set and master that skill set to then move forward with the other goals that I have within my life. Trading isn't end all to be all. I would love to open up a clothing line. I would love to get back to gaming. That is ultimately what I would like. That's what I fucking love to do. But like I mentioned before, gaming right now isn't doing shit for me beyond giving me pleasure. Fuck do I want a game for? I want money. Fuck it. Like, I don't want that shit right now. Eventually, I want to be able to sit down. Eventually, I want to wake up, open my phone, follow the same routine that I do, work for 2 to 3 hours, trading, and then go focus, make my money, and then go focus on my other goals. And go focus on whatever the fuck I want to do with my day. I can trade. God, I'm gonna get to a point where I am trading with $250 and making about $1,000 a day, and then beating my fucking dick off raw for the next 12 hours. I'm joking. Not maybe that's excessive. But you get the point. I can do whatever the fuck I want if I can just master this craft. I'm getting excited. You get the point. You want to be able to learn a skill that multiplies your money for you. Day trading is one way, not the only way, to multiply your money for you. It is a way. Right now, this is my way. Your end goals should be as big and thick as LeBron James' dick. It should be just so fucking big. You want to be reaching for the stars, my guy or my girl, because we're not going to be discriminating around here. You want to be reaching for the motherfucking stars. I don't get, like, your goals should be so big that anybody that knows your goals looks at you and tells you you're fucking crazy. You want to then use that response as energy and fuel on a daily basis to prove not only them right or wrong, not only to prove them wrong, but prove yourself wrong on a day-to-day fucking basis. To show yourself that you can fucking do this shit. You want to be able to repeat this shit on a daily basis so that way you could prove to them and yourself that you could fucking do this. And if you do that, your end goals are going to be what this is. Like me, I want to own a Brabus. I want to own a fucking Brabus. And my interior, I want it to look like that. Not only that, I want to be able to live in Puerto Rico. I want to be able to have my family walk around in a house like that and not have to worry about a goddamn thing. I want to be able to go ahead and look at my kid and look at my girl and just be like, hey, are you ready for the flight? And then look at me like I'm fucking crazy because they don't know nothing about the flight that I just booked them to Miami. Or back to Chicago. Like, I want that kind of fucking energy. I want to be able to, like, those are just one set of goals, but the ultimate goal that I want to be able to achieve with this is walking down the street and just handing somebody $500. I don't want to know your fucking story. I don't need to know your fucking story. What I am hoping that you do is use that money for a good reason or a way to help you get out of whatever funk that you're in. Or if you're not even in a funk, hell, keep it. Say that. I don't give a fuck what you do. It's just for you. It's for you. I want to be able to help people with this. Not only teach people, but be able to share the wealth that I am getting just because of the way that I'm being blessed. And I want you guys, if anybody has that same kind of energy, I want you guys to go ahead and carry on with the same purpose and the same morals and the same values, because that's the only way that we make shit better. You shouldn't give a fuck about the other person's fucking story. It's all about just helping. It's just helping. Like me personally, I'm not gonna cry about the help that I don't receive. I don't give a fuck. I'll get myself out of it. I will crawl through the glass. I will cut my shit open left to right until I am able to get to where I need to be, to lay there and be healed. But right now is being able to help you guys and help anybody else that is willing to watch this video. Alright, the strategy is very simple and very fucking straightforward. It is only 6. Yes, it is only 6 fucking rules that you need to abide by. There's only 6 motherfucking rules that you need to abide by every single time that you're looking to take the fucking trade. Alright? Those 6 rules would be... The first rule is a liquidity sweep. The second rule is a break of structure. Third rule is either a fair value gap or an inverse fair value gap. The other rule is a SMT. And the last one is a 79 extension for Fibonacci. Now, you guys are probably like, the fuck is this shit? The hell is this guy talking about? That's okay. It's okay. I don't blame you. I don't blame you whatsoever. Because I was the exact same fucking way. I was dumbfounded, confused on what the fuck this guy was explaining. But when he broke it down the exact same way that I'm about to break it down for you, it made a lot more sense after I applied it the way that he taught it. But before I go ahead and teach you what the strategy is, it would be an injustice to you guys to not explain the definitions and how to use those said rules in the right way.
Mama's already up. Mama's already up.
The strategy is very simple. You just need to go ahead and abide by those 6 rules, and then just those 6 rules. The strategy works. You just need to make it work. Now, on top of that, we need to understand that it's not going to be foolproof. What the strategy does do, though, is give us a high probability on a day-to-day basis whenever we do take the trade in order to come out on the winning side. Once more, I keep repeating this, and I'm going to continue repeating this. We work off of probability. We ourselves don't know for a certain fact where the market is going to go. We use our confluences as tools to help us determine whether or not our bias is correct for the day. Market, I need to state this. Market doesn't give a fuck about your strategy. It doesn't give a fuck about your strategy. It doesn't give a fuck about your thought process. It doesn't give a fuck about your feelings. It's going to move in the way that it wants it to move. It is very, very, very important to also understand who is moving the market. There's just 2 groups. There's big banks and big industries.
Okay, Thor. Thank you, bud. Lay down.
And those are the only 2 factors that are moving the market. Oh, I lied. There's 3 factors. Those 2 factors, right? And and people out there looking to take the trade, buyers and sellers. Those 3 factors are what moves the trade, or what moves the market. Point being is, we don't know, or we are not able to predict where the market is going to go. We can't do that. The only thing that we can do is use our tools to help us determine if we're going to have a higher probability of our bias playing out in that day. Cool? Cool. Now, what of our biases again? Or what of our biases? Ha ha ha. What are the rules? Well, simply put, we are going to start off with the first one, and it's liquidity sweep on the 1 hour, 4 hour, or the day, high or low. How do we know what liquidity is? Liquidity, simply put, as I would explain to my child, is just resting buy orders or sell orders waiting to be taken out. That's it. That's it. Just resting buy orders or sell orders looking to be taken out. That is the simplest way that I can tell you that without getting you confused. The other rule that we have to understand and definition that we have to understand is a break of structure. What is a break of structure? Forgot that I left out. I left out with liquidity. When a liquidity sweep happens, it is a change in direction. Market is usually going to want to reverse off of the high or the low that it swept. You can see this happen on higher time frames. You can see this happen on lower time frames. Point blank period is the fact that it happens. Now, is it a solid, definitive fact that it's going to flip? No, but it has the potential to do so. That is the liquidity sweep. Liquidity sweeps are just rotations in the market to go up or down. Breaks of structures are treated the exact same way, i.e., they're a confirmation of change in direction. Simply put, that's exactly what a break of structure is. Break of structure is just another way to tell if the market is confirming that it's going to go in the opposite direction that it's going to go in. So if market swept a 1 hour high and we're looking for price to drop, we're looking for a break. We're looking for a break of structure. What is a break of structure? Break of structure is when a prior high or a prior low gets tagged out. Let's get into the chart. Let's just get into the chart because it'll make things that much simpler. Okay, so breaks of structures are just a prior high getting tagged out. So here is, in this case, a high right here. We can see another high formed right there. It took a while for price to go ahead and jump, but after that break of structure, price confirmed that it wanted to go up. It didn't matter if it was going to take a while. It's just going to go up. Again, what are breaks of structures and how can we tell what a break of structure is? A break of structure is just a two-part candlestick closure. We're looking for one candlestick to form, which is the green candle, up candle. We're waiting on this candle to print, and then we're waiting on the second candle to print to see whether or not it is engulfing the prior candle or if it is below a candle, below the prior candle that looks like this. But in this case, again, we're looking for a positive break of structure, and this happened. Here's one low, or here's one high right here. Here's the other high that took out that high, which confirmed that price was wanting to go higher. All right? That's the second rule. Something to keep in mind with breaks of structures is it will always come after a liquidity sweep. It will always, always, always come after a liquidity sweep. All right. So we're moving on to a fair value gap, and a inverse fair value gap. A fair value gap is just an imbalance in price. What does that look like, and how can we see that? So let me see if I can find a positive one. I do see one right off the bat. Let me get my tools out so that way we can mark this out properly. All right, so to find fair value gaps, we use our rectangle tool. To find a fair value gap, it is a 3-part candle closure. You'll have one candlestick at the low that looks just like this. It could be high, it could be low, but the wick is what really does matter in this circumstance. So we use this wick. We use the first wick, and then we use the last wick for the third wick. Does that make sense? Let me explain that in a different way. We use the first candlestick's wick, and then no, that's not the right way. We use the first candle's top wick, and then we draw out our rectangle to the third candle's lowest wick to find the imbalance in price. The imbalance in price is this right here. To determine whether or not it's a good fair value gap or a bad fair value gap is such. For a good fair value gap, you will not see a wick or a candle's body close out of the fair value gap. Price will respect the fair value gap and the imbalance and use it as a support level to go higher. That is a fair value gap. A inverse fair value gap is when you have imbalance in the market just like this and you find it, but price doesn't respect the imbalance and blows through to the downside, which would cause the inverse. It reversed itself and filled in that fair value gap. What is a fair value gap again? It is a imbalance in price. How do we find it? We use our rectangle tool to draw out the first top wick of the candle and drag it out to the third last down wick of the candle. It could be red or green. It doesn't fucking matter. It could be red or green. And see if there have been any other wicks after imbalance is made and see if it's been filled. If there was a candlestick filling the imbalance after it has been formed, that imbalance is no longer good and it's been filled already and it's no longer good. Once it does get filled though, it is called a inverse fair value gap. We use both of those though, and I will go deeper into how we use them, but again, this is just a fine understanding to what each confluence is, so that way you guys know how to use them in the most appropriate way. All right. So that's an inverse. So liquidity sweep, break a structure, inverse fair value gap, fair value gaps. Now we're on to SMT. We are flying through this shit. Damn, we are flying through this shit. All right, so an SMT divergence is when you have Let me stop there. The way that I trade is I trade off the S&P 500 and the Nasdaq. I use those two correlating pairs to help me determine whether or not I could take a trader. Whether or not I could take a trade. The SMT divergence allows me to tell which pair is going to be the strongest pair to use for the trade. The way that I like to explain this to newcomers is such. With the understanding that I use two pairs, you don't have to use two pairs. You could use one pair. You don't have to use the SMT divergence if this is too complicated for you. But I cannot promise you that you'll see the same results. I can't promise you that. What I can assure you, though, is if you have the understanding of how an SMT divergence is formed, you're able to go ahead and apply it the right way that you needed to apply it and have better results. Like I said, the best way that I can explain this to newcomers is like so. These two pairs I treat as brothers. Just like a coach would want to choose his stronger athlete at the final game and leave the weakest one out, is the same mindset that I want to be in when taking a trade. I want to treat each trade like a final fucking show that I'm never going to have again. With that being said and done, I want to use the stronger brother, the stronger pair in the trade to see it play out. An SMT divergence is going to help me determine which pair is going to be the strongest in that time frame. How do we determine when an SMT divergence has happened? The way that we can tell that is when we get close to a higher, like a 1 hour high or a 4 hour high, say the NASDAQ tags one of those two levels out, where the SMT won't even come close to those two levels. Once we see that happen, I know for a fact that the NASDAQ is going to be the stronger pair because it took out that 1 hour high or that 4 hour high. It had enough capacity and potential to whip through that, where the S&P 500 didn't even have the potential or the strength to take out the 1 hour high or the 4 hour high in the exact same time that NASDAQ did. So, with that being said and done, when a 1 hour high or 1 hour low gets tagged out on one pair and doesn't do so on the other pair, we know it has an SMT divergence has happened. We can see an SMT divergence happen on higher time frames. I would use my SMT divergence on a 1 hour, 15-minute, and the 5-minute. That is the lowest that I would go to find an SMT divergence. I know many people out there, and I've seen this happen on more times than not, where if the SMT divergence doesn't happen, people don't even fucking take their trade. They won't even take their trade because that is a definitive reason to take the trade. One pair is stronger than the other, and it's the leading cause for you to play it out. So take it as you would. You could use that confluence. You don't have to use a confluence, but I can't promise you that you'll see a lot of success without it. I didn't see any success without it. I thought for a certain fact that I would be okay without using two pairs and or hell even the SMT divergence in general. But once I started applying once I started really learning how to use SMT divergence, I started seeing my capital multiply, and I was able to see my trades play out a lot more than I would have without it. So now that we have the SMT divergence capitalized and done for, we can move on to my least favorite extension, which would be a 79 extension on the Fibonacci. People people love using the Fibonacci retracement on because it can be reliable. But the way that I use it and the way that I understand it doesn't it doesn't really give me a good entry right away. What I use the 79 extension for is strictly for like last resorts. If I am late to the trade, if I am late to the party, I am using that extension to help me find the last move down, the last move up. If it makes sense, if the risk to reward is there, if it makes sense, I am using the 79 extension. If not, then fuck it. I'm not even taking the fucking trade. I don't give a shit. I'm not saying that I won't take the trade. I won't use the extension because there's a lot of times that I don't find myself in that circumstance. There's a lot of times I'm at my phone ready to go and not late. 79 extension is just a retracement tool that you're able to use to help you get back into the game and find a last leg up or a last leg down. You want the 79 extension on the Fibonacci to be hit either on the upside or the downside for you to enter into the trade. But you're not going to have any other confluence but that. but that. You see where I'm going with that? You see why it's my least favorite one? Because that's the only confluence that you're going to be able to rely on if you are late to the fucking trade. You're not going to have the other 5, 6. You're not going to have the other 5 confluences to back you up and give you confidence to play out the trade in the right way. That's not to say that the trade won't play out right, because it probably would if your bias is right, but your probability went from 50-50 to like 25-75. Hey, like, I'm not okay with those numbers. I am not okay with those numbers. Just like I am not okay with this kid numbing my hand off. Jeez Louise, Papa Bees, he is heavy. Anyways, moving on with the bullshit. We have, look at that. What are we? We are about an hour and 12 minutes in. Probably going to be about a 30-minute video for this first portion. I don't know how I'm going to break this up. I don't know how I'm going to break this up or if I'm going to break this up. But the point being is we are moving the fuck on in a timely fashion. I did this video like 3 different times, and the first 2 times, let me tell you, ass. Look, she shakes her head at me because she knows. All right, now that we have an understanding to what the rules are, we can go ahead and apply the rules to, well, we can actually not just apply the rules, but we can formulate a game plan to use those rules to have a good probability in the trade. Anywhoosies, I keep a cheat sheet set aside for myself so that way I stick to it. I really shouldn't be using the cheat sheet so often. Like, I really should be focusing on memorization. But when price is moving as fast as it's moving, and your only problem is psychology, you want to be able to have good coping mechanisms to help you better off, or help you be better off in the circumstance. My coping mechanism is to have my fucking cheat sheet ready and available at all times. At all times. I've played out these trades in the same format for the past 3 to 4 months and have enough confidence in myself to know that I shouldn't be using this and I should just be using memorization. But there's a big part of me big part of me that just yells and screams to never get rid of this shit. Because I truly believe it's only because when I didn't have it and ready and available, I failed more times than not. Even though I had the confidence and knowledge, I just didn't stick to the rules. And having this in front of me helps me use it as a checklist and helps me stick to the rules. Like if, well, I'll actually break this shit down for you. Now that we have that, go ahead. Now that we have all that understood, I could move on to the next portion of this, and that would be to help you understand how to find highs and how to find lows in the market. Because without the understanding of where highs are and where lows are, you won't understand where the liquidity is for your session, or even if it's been swept. You can talk to me. What?
Can I hold pasta in here?
No, you can cook it in there.
No, hold it. Like.
Oh yeah.
Okay, it's not gonna like damage it or anything.
No, you're good. I do not like to follow candle pattern charts. I don't believe in head and shoulders. I don't believe in mountaintops. I don't believe in like all this fancy wording. I don't believe in that shit. But what I do believe in are the candlestick formats that equal out to a fair value gap. Like I mentioned before, there's a three candlestick closure pattern that always happens when a fair value gap is formed. There's always going to be a candlestick pattern that forms when a breaker structure happens. Like those are the only patterns that I would follow. But the other thing that I would also have to understand, or also had to understand, what you guys have to understand, is that there is a two-part stick candle closure when it comes to a high or a low. How do we determine what is a high and what's a low? Very, 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 very fucking easy. Very fucking easy. But I know that you guys are going to overthink this the exact same way that I overthought this, and probably had to look back on this video more times than not to give you the confidence that you need to determine whether or not a high or a low is formed. Whew. Alright, so we're going to start with what is a high and what is a low. My chart looks different. Your chart's going to look green and red candles. Green buy, red sell. My candlesticks and my charts look different because I set it up differently. I like the way that it looks. My green candles are teal candles. My sell candles are purple candles. Cool? Cool. So, how do we determine what is a high and what is a low? We have a green candle and we have a red candle. I use the top wick, the highest wick of those two candlesticks to find the high. So we have a green candle, we have a red candle. What is the highest candle wick of these two candles? Well, that would be right there. That is the highest point of those two candlesticks, which would equal out the high for that session, if it was marked out properly. How do we find a low? Same method, just in reverse. Two candlestick closure, but we're using the purple and we're using the green. Here, we'll use this. We'll use the purple and a green candle. What is the lowest candle wick out of these two candlesticks? It would be this one. Okay? That is how you find a low. Once more, a high is formed with two candlesticks, a green and a red. you're finding the highest point of those two candle wicks and marking it out with the ray tool for a high. For low, you're using the red candle and the green candle's lowest two wicks, determining which one is lower and marking it out for your low. With that understanding, you can indefinitely tell where liquidity lies, if it's been hit, if there is a break of structure. That portion, knowing what a high and a low is imperative to continue on with the understanding of a liquidity sweep and a break of structure. It is, you need to understand that shit. You need to have that shit ingrained in your fucking head. I probably should have let off at that, and shame on me, but here I am now explaining it to you fucking monkeys. Cool. Now that I got that out of the way and down packed, we can move on to the fun part. The fun shit, which is building the trading strategy. Again, you don't have to follow this list, these rules in the way that I do it. Not every trader is going to be the exact same way. Not every trader is going to trade in the exact same way. Not every trader thinks the exact same way as the other traders do. There's always going to be differentials when it comes to this shit. If you don't use all these rules in the exact same format, that's okay, but I cannot promise you that you're going to see the exact same results that I have seen or anybody else that uses this same results. You. Stay. I can't assure you that you're going to go ahead and see those same results. So I would suggest, and we're not, okay, I can't suggest it. I would hope that you guys go ahead and follow these rules the exact same way that I'm about to go ahead and give them to you. With all that said and done, we have the understanding that we can finally wrap back around to the understanding that this strategy isn't foolproof. It's going to have its quirks, it's going to have its setbacks, it's going to sometimes fail, but it plays out in a most positive way more times than not. With understanding everything that I just told you, you can you can determine whether or not to go ahead and take your trade. Hopefully you guys have a pen and paper. Hopefully you guys are able to write this down. If not, you're able to go back and rewatch this shit and learn something. With all these confluences set in motion, or set, we can set them in motion. We can label them out. We can go ahead and use them as a checklist. Once more, we have 6 rules, 6 ways to go about this, and we follow them. The first way is 1A, and that is we look for a liquidity sweep on the 1 hour, 4 hour daily highs. All done on the highs in the same way with the lows. 1B is we look for prior session highs and we wait for prior session lows. We mark those all out. 2B or 2A is a 5-minute confirmation confluence. How do we find those and what are those? Simply put, those are everything that we had just went over. Breaks of structure, inverse fair value gap, SMT divergence, and a 79 extension on a Fibonacci. We only, in 2A, we're only needing about 3 of those confluences to play out. We would need the break of structure after the liquidity sweep, The way that I would do this is wait for the liquidity sweep. After that, break a structure, inverse fair value gap, and my SMT divergence. Those are the only three that I'm using in 2B. After we have already established that 2B is done and happened, I'm moving on to the third stage. Now, there's going to be times where price takes out a 1 hour high or a 4 hour prior high before pre-market. It would usually happen at like 7:30 or well before 7:30. When price seeks out those levels around those time frames, we're looking at 2B and following suit right there and starting off, right? Because we're not looking for straight off. We're not looking for the 5-minute confirmations. We're not waiting for the 5-minute confirmations to go ahead and apply themselves, only because majority of those confirmations have already been applied and tapped into well before our market has went ahead and happened. So what are we doing? We're looking for the liquidity sweep, as I mentioned, and we're waiting for a 5-minute manipulation. What is a manipulation? Manipulations are retracements to the upside or the downside. But we're waiting for it to happen on the 5-minute time frame. Once it does happen, we can continue with the rules. Third rule is the 5-minute continuation confluence. What would that be? An equilibrium? What is an equal? Oh, that's one thing I left out. Equilibrium is just a perfect way to see where a discounted price is. You go to the store and you see discounts and you buy that discounted item and you save money. Well, that's the exact same purpose with an equilibrium. Equilibrium just allows you to determine whether or not you're in the right range for a discount, or if you're about to buy price for full price. If you're about to buy in for full price, or you get a discount in the price. That's what an equilibrium is used for. If we don't have an equilibrium being tapped into, we're waiting for the fair value gap to form. We're waiting for the fair value gap to be formed and then tagged into. Once we see the fair value gap tagged, we're moving on to the fourth rule. But okay, all right. All right. Anyways, like I was trying to explain, after we go ahead and have the third rule go ahead and checked off, and if we are not in the situation of 2B, we're moving on to the next set of rules. If 2B has applied itself and has already been done, we're looking at 3B for rules to follow. If 2A has happened, we're looking at 2B. What is 2B? 2B is just an SMT divergence to continue. If we're in that situation where price has already gone and tagged out a 1 hour high or a 4 hour high, daily high, whatever high or whatever low, we're already well past our confluences, and the only way that we can determine if we can take the trade is if we have an SMT divergence form. That is the only confluence that is going to show itself, and honestly, that is the only time that I would feel confident to say that that is the only confluence that I would use to enter into trade with. That is the only time that you're gonna ever hear me say that is the one fucking confluence that I'm using full force and full outright with to take my trade. If we're not in 2B, We're not using 3D. If everything is as normal, we are continuing on with the fourth rule, and that is waiting for a 1 minute confirmation confluence, which comes in a break of structure, inverse fair value gap, or if we're late to the party, a 79 extension on the Fibonacci. I'm going to show you how to play this all out when we get to the charts, but for right now, this is the trading strategy. After you had majority of all four of those rules hit, we're now looking to enter into the damn trade. Why? Because we've already had enough signals and enough confidence to enter into that motherfucker. There's nothing else that we need beyond hitting the fucking buy or sell button. That's literally all that we need now, and just watch price go to our stop or watch price go to our take profit. That's the only thing that we need to do from there on out. After we enter the damn trade, we need to target previous draws and liquidity in our direction, whether that be 5 minute, 1 minute highs or lows, or even if you're able to shoot for the stars, 1 hour lows, 4 hour lows, 1 hour highs, 4 hour highs. That is the trading strategy. That is how I carry out my trades on a day-to-day basis to give me enough confidence to say that this shit works. We'll go through this shit. We'll go through this shit right here, right now, and have this shit play out. Okay, so let's go to a chart that is just a tad bit prettier, because this looks like my fucking mom after she has gotten done taking care of and having a third child. What is this, NASDAQ? Let's go to the S&P 500. Would you look at that? Beautiful, beautiful. All right, so the Thanksgiving holiday is it's happening right about now. And with that being said and done, there's other situations about. One major situation that has occurred is there was a data problem when it came to futures. You were not able to place a trade. You were not able to place a trade whatsoever. You were not able to get any kind of data for futures, for S&P 500, for crypto, when it came to certain platforms that you traded on. So with that being said and done, there's going to be a lot of dead space and a lot of dead times. I think you're able to see it better. Yeah, so the NASDAQ is where you can definitely see that dead space right here. It took them a while to get everything back up and running, but you can see it. Anyways, we're gonna go through the market as if we didn't even take a trade today or mark anything out. What I would do, and what I've grown into the habit of doing, is either marking down the night before what market is doing right then and there, and or waiting for the next day and letting price develop to draw out my draws of liquidity. If I'm doing the second option, I'm waking up about an hour before market opens and drawing out everything that I need to draw out. This is exactly how I would do it. Normally I would have lines out and established to determine where I would have my lines drawn out to determine where these sessions are. For your understanding, markets open 3 different times. Market opens in London session, which would be 3 o'clock in the morning. New York time, if I could just label it. That's London. New York opens up at 8 o'clock, 7 o'clock our time, 8 o'clock New York time. And Asia opens up at 7 o'clock New York time, 6 o'clock Chicago time. With that being said and done, with those rules set in motion, I mark out my chart just in this way. I mark out the 3 o'clock open, I mark out the 8 o'clock open, and I mark out the 7 o'clock open. I do that to help me see what price has done in each session. So, 7. Let's just continue on with this. Market closed pretty early today because, well, it's Friday. Markets close at 4 o'clock on Friday and usually close about. The markets don't usually close until the next session. And that's what I love about futures. Your market is going to play out in the way that's going to play out. Where Forex, you have to wait until the next session for your trade to even play the fuck out. I don't like that shit. Anyways, this is 3. I need 8 o'clock. And market closed around 2. So 3 o'clock is when market closes on Friday. Okay, so now when I have all that drawn out, I am looking for prior highs, 1 hour highs, 4 hour highs to be drawn out. And it's kind of hard to determine how to, yeah, it's like, so this is a really good way for me to go ahead and break this shit down. There's going to be some times where you don't see a 2 candlestick closure and you have to use the green candle that is formed. So right here, we don't really have that problem. We have a high and we have a low. We're going to use the highest point of those 2 candlesticks to determine where the high is for that, and boom. The high is made for that. Don't have to worry about that. Where's the low for this session right here? Well, it's right here. Boom. Low made. Done. And then we have prior lows. That's really bad to use. Sorry. You know, we're just going to focus right here. We're just going to start over here because this looks just a tad bit better than the other session, than the other sessions that we're working out. Okay, so I'll fix these colorations in just 2 seconds. Low. You want to be able to get so good and have enough practice to where you're just flying through this shit and know exactly what is what and where is where. What time is this? This is 8 o'clock. Okay, so I know that this is a high for New York, for Asia. And then, where is the low? It's still there. What time is this? 10. Okay, so this is this session. And then this session. Okay. I'm pretty sure we're able to jump into the 5-minute now. Let's see what's what. Okay. Alright. Sorry for all the jangling, but you know how to deal with it. Just do a little bit of colorization here. It's not gonna look perfect, it's not gonna look the greatest, but you guys get the fucking concept. Alright, so where is our session? I'm gonna mark our session out in green so that way I can determine what's happening. Now, after I've done 1 hour highs, 4 hour highs, let's do prior lows, prior highs. Prior high. And then I'm gonna another high up here. And then we have a low down here. Bruh, you wanna get the fuck off of me? This dog is just digging his asshole straight into my side. Okay. And then we'll mark out these lows down here. Probably should try marking out with one more low. Hey, stop. If it's not the dog, it's the baby. If it's not the baby, it's the fucking dog. Okay. Mr. Gowson. Okay, Mr. Gowson. Now that we have all that situated, we can now go ahead and jump into the 5-minute time frame to see where we are at. Right, actually, once we have everything drawn out, what I am now doing is looking at the daily profiles to see exactly what is what and where is where. Starting with the weekly profile, looking to see what we're doing. Well, did this high close above this high? Nope. So what does that tell me? We're still bearish. Price is still down, but we have a slight retracement to the upside on the weekly. Cool. Do the same thing on the daily. This high, get over this high. Nope. What does that tell me? We are bearish on the daily. We go to the 4 hour. What do we do? Would you look at that? We can see that same retracement right here that was on the daily and the weekly. Alright, so here's the retracement. There's the downside. Go to the 4 hour. We can see here's the retracement. Here's the retracement. Here's the downside. Here's that big downside. Cool. All that is still adding up. I got one more time frame to see what's happening. The exact same thing, just on a bigger scale. Large move up while we had that large move down. Cool. What is this telling me? We are bearish still. Why am I thinking that we're bearish? Is simply put, higher time frames hold higher power. I don't give a fuck what happens on the 5 minute. I don't necessarily give a fuck about what happens on the 1 minute. I care about what happens on the 15 minute. I give a fuck about what happens on the 1 hour, 4 hour, the weekly, and the monthly. Higher time frame will always hold higher power. That being said and done, I can now go into the other confluence, which would be to find out what daily profile we are in. There are 3 daily profiles that we can establish after finding out what daily bias we have. We need to first find out what our daily bias is before we can even determine what our daily profile is. Alright, so right now, my daily profile is bearish. I'm thinking price is going to go down. Alright? Cool. Are you okay?
Yeah, why?
You seem annoyed about something.
No, I'm not annoyed. I'm just opening the door because it's getting hot in here.
Alright, so we have 3 ways that price can go ahead and play out. 3 different profiles. We have London manipulation. Oh, let me get the cheat sheet. I have another cheat sheet that tells me that. Same explanation that I'm about to tell you guys. I mentioned this multiple times in different videos, but I feel as if I need to continue to repeat myself to make you guys understand a little better. Alright, so there's 3 daily profiles that can happen. They come in the form of London manipulation, which would then carry over into New York reversal. We then have London manipulation plus reversal that would lead into a New York continuation. The last profile would be London consolidation into New York manipulation, which will have New York reverse after the manipulation. If, with those 3 daily profiles in mind, we can use that to have a higher probability to determine where we want to take our trade. We look here to see what London did to Asia. What did London do to Asia? Did London take out a high? Did it take out a low? Let's see where Asia actually is here. 7 o'clock. And the highs there, the lows there. So we have our Asia high right here, but we have our London low, Asia low down here. So you blew through pre-market. No, so when this happens, like I mentioned before, I had that marked out the wrong way. Alright, so what did London do to Asia? Let's get rid of this so that way it's I can explain this a little better. Did London manipulate a high or did London manipulate a low? Well, when London opened, we can see right off the bat that it manipulated a low. Cool. We have London manipulation. Now we have 2 ways that the profile can play out. London manipulation into New York reversal, or London manipulation plus reversal into New York continuation. Now, do we see a reversal happen, a strong reversal to tag out the 1 hour or the 4 hour highs? No. So, London manipulation plus reversal into New York continuation. Wait, London manipulation plus reverse, so into New York continuation is not a thing. London consolidation isn't a thing because it didn't consolidate. What did we do though? We ended up taking out one of the lows. So London manipulated. Now, what are we doing? We're looking for New York, our session, to reverse in some way. But before we can see a reversal on our side, we need to wait for the 1 hour to get tagged out on either the 1 hour London high or 1 hour London low. Alright, so here we can see that we don't have an appropriate. That's a bullshit lie. That's a bullface lie. Got a low right there. Sorry, I had to make this a little better for us. So, we can see that London had its low right here. We came through, we opened up, we blew through that low. Awesome. What am I doing? Sorry, it's kind of hard to explain this while I hold the baby at the same time. But we're doing our best here. So you can wait on the 1 hour time frame for your high or your low to get swept, but me personally, what I'm doing is I'm automatically waiting in the 5 minute. I'm sorry. Did I say 5 minute? I meant 15. I'm automatically waiting in the 15-minute time frame just to wait for the liquidity sweep. I can have more information on a lower time frame than I do on a bigger time frame. So I am waiting on a smaller time frame for liquidity to sweep. And as soon as we open up, I can see that we swept. Boom. Great. Now, what am I waiting for? Liquidity swept. I am waiting for break of structure, inverse fair value gap, or the 79 extension. Hold on, let me get my note out in front of me so that way I'm not giving you guys improper information. Alright, after the liquidity sweep happens, we are waiting. Hold on, let me get the actual cheat sheet. Because the one that I let me get the proper cheat sheet. This little motherfucker's just gonna have to wait. Yeah, I know, you're fine. Okay. After the liquidity sweep, we have the. Yeah, no. Nope, we're not doing that. Alright, now that we have the liquidity sweep happen, we're jumping into the 5 minute time frame. I am now patiently waiting for my confluences to hit. One thing to go ahead and keep in mind is noticing whether or not you're in a good environment for trading or a bad environment for trading. If you jump in, usually you'll see if you're in a bad environment on a higher time frame, because it would look just like this. It would look just like this. This is called barcode action. This is also seek and destroy environment. Price is seeking out liquidity on either side, the highs and the lows, to bounce up and down for a long period of time to then have it go in the way that we want. So, if we were looking to take a trade today, we were waiting for this negative environment to pass then look for our confluences after the fact. So, in this situation, we are. Let me get rid of this. Let me remove the camera so that way it's a little easier for you guys to see. Right. So in this situation, I'm not looking to enter in a trade, nor am I looking for my confluences to add up. Just about 1 o'clock our time. I'm sorry. Just about 1 o'clock their time, New York time, we finally got a good push up. I am now looking for my 5-minute confirmation, which would come in a break of structure or inverse fair value gap. There is no fair value gap for it to be inversed, so I am waiting for a break of structure. What is a break of structure? Simply put, is when we have a prior high or prior low taken off by the exact same color, to put it like that. We have a high right here and another high formed, which engulfs this high. We actually have a gap formed right here, but that's even better for us. That you will sometimes see this, or you will see full body candle with a small wick, or vice versa, to overgap this, or to engulf that prior high. That point, I'm moving on to the second part of this, which would be to see if, what is this? If Nasdaq, we know Nasdaq took out the high, but did the S&P do the exact same? I'm sorry, I meant to say the low, not the high. Let me just get this situated because I did not mark this out for an S&T. Okay, so we could see that the SMT was made. The S&P 500 did not even come close to coming down to these lows, where the Nasdaq didn't have any problem at all blowing through this shit. So with that being said and done, we can tell that the S&P or the SMT divergence has already been happening. We are using the Nasdaq as the stronger brother to take the trade. Why? Because the Nasdaq is the index that had enough power and enough pressure to blow through that low, which means is going to have enough force to continue on in the opposite direction. Where the S&P 500, as you can see, at that time, just did not have enough force. Like, look at this. Look at this compared to the Nasdaq. See, you seen how weak the S&P 500 was? Compared to this? Like, this gap right here, this up move right here is so much bigger than the one on the Nasdaq, or the S&P 500. So, after we've seen that the SMT divergence has happened, I am now jumping into the 1 minute. We're jumping into the 1 minute. Or, I'm sorry, we're not jumping into the 1 minute. We're waiting for the 5-minute confirmation to the upside. The 5-minute confirmation or continuation to the upside will come into an equilibrium or a fair value gap. After the SMT, after the break of structure, looking to see if a EQ where the F, the fair value gap, was formed. Equilibrium. We take it from the lowest part, the last swing low, to the last swing high, which in this case would have been there. And would you look at that, after the break of structure, price just with the same candle touched right into equilibrium. I'm already in the 1 minute time frame. After I've seen a red candle down on a 5 minute, and I've already drawn out my equilibrium, I'm already into the 1 minute time frame to see whether or not price is touched into equilibrium, which would have been this level, which would have equaled out to this candlestick right here. Would have seen that happen. I would have taken off the equilibrium because we don't need that anymore to enter into the trade. What I'm now using is a break of structure or an inverse for value gap. We do not have an inverse for value gap to use, but what we do have is a break of structure. Where's the break of structure? It happens not with this candle, not with this candle, not with this candle, not with this candle, but with this candle. So I'm patiently waiting for all this time for this candle to engulf this candle. What am I doing from there on out? I am entering into the fucking trade. How am I entering in? Well, I'm targeting the last two lows that I have. So here's the first low. Let me make sure that this is right. Let me make sure that this is right first. So, break of structure in the 1 minute. Hey, stop it. Chill out for like 2 seconds, yeah? After I found the break of structure, cool. I will lay you down. Yeah, you can lay down for like 2 seconds while I finish off this explanation. I am not putting my stop at this low just because you could put the stop at here. Like, let's see if this actually plays out. I would normally put it all the way down here, but this would cost me more money. So let's see if putting the stop here would be better off. Hold on. Break a structure. I'm entering in with this candle. Let's say gotten at the high. I'm putting my stop at this low. I'm looking over to the right to see which part of the liquidity that I could target. I can target either... Now, I would usually also have these levels marked out just because I don't like doing this prior to. So let's say that's a one level that I could tag for liquidity. Go into the 5 minute. You can see that that is also a draw liquidity that I can target. I would have about 4 draws of liquidity to target just in case. You could have 1 to 2 to 3 to 4. I wouldn't exceed any more than just 4 draws. And this draw right here. Alright, now we're going back into the 1 minute. And then now, what am I doing? I'm just targeting those draws that I've put in. Now let's see if we won that trade or if we lost. And would you look at that? We would have won that trade. Or if we wanted to be ballsy too, I actually would have put my trade up to here at the high, marked out my levels of liquidity like I did right here. And then I would have just waited for price to show that it was going to rotate off of itself and then just hit. So as you can see, this trade right here would have played itself out perfect. As soon as I seen a reversal happen, I would have kept eyes on this. This high would have got it blown through. I would have waited to see if there was a candlestick closure to the downside, which we did get. We get this candlestick closure and then this candlestick closure. I'm automatically out. I'm not waiting for a higher time frame closure. I'm out. But you can see how that, with that strategy, you would have been able to carry out the trade and win just a good amount of money. If you entered into the trade with $250, well, let's say if you entered into the trade with $50 times 256, you're walking away with about $128. Now, $128 times a month, 4 weeks, you're making just about $512 a month. $128 times a year, you're making just about $1,000. Now, if you get more comfortable and you're able to size up your amount, say my goal for a size up within the next year is about $250. If I could times that by 1,000 by 4 weeks, within the month I'm able to make about $1,000. Times that by 12, by a whole year, I'm able to go ahead and make $3,000 a year. That's just with $250 though. Now, if I get more comfortable with the sizing up, and I'm allowed to trade with $500, the 2.56. Was that 2.56? Yep. I'm able to go ahead and make $1,000 a trade. That $1,000 times 4 weeks, $5,112 in a month. Times that by a year, I'd be able to go ahead and make 15 grand within the year. So with confidence and with scaling, you can see some shit happen. But as a beginner, you don't necessarily want to see that play through. You don't want to size up too drastically or too rapidly. You want to stick with one set of amount and leave it off with that. That is a whole breakdown. There's a whole fucking nutshell on how to take the trade. That is just literally showed you. I didn't even take a fucking trade today. I didn't even bother to mark out anything today because I wasn't interested. But I showed you how you can go ahead and just play out the trade in the way that you needed to have it play out in your favor. Or was this today? Oh, this is yesterday. Okay, I didn't even take a trade yesterday. Didn't even bother taking a trade yesterday, but this is how you could have played out and won just a little bit of money doing a trade yesterday.
Are you hungry?
With that being said and done, guys, I hope that you guys can look back on this and replicate everything that I taught you and apply everything that I taught you. I'm really hoping that you guys can look back on this and take enough notes. Like this, all this is imperative. All this is good information to use. You do not have to use my strategy. You do not have to use my concepts. You don't have to use my model. You can go off, and if this strategy doesn't make any sense to you, that's okay. That's fine. Go find another strategy that's going to work for you. Go find another model that's going to work for you. Go find something that's going to work for you. Because ultimately, that's going to be the only way that you're going to succeed, is be able to understand what you're doing and apply it multiple times over to have it be positive instead of negative. Okay? So, again, this was all just for the people that claim that don't have the time, don't have the what not to do it. And when you tell me that you don't have the time to do it, I don't fucking believe you. I really don't believe you. I really believe that you have enough time in your fucked up day to get some shit done. It's just all about how you manage your time. Like right now, I assure you, it's 6 o'clock my time, but majority of my friends that have told me that wanted to learn this and keep telling me that they want to learn this are either with a girl and fucking around with them, or fucking around on a video game and not really seeing much of anything happen for themselves beyond continuing to say that they want to do this and the third. But this is going to help them with the know-how and get started with it, because now there really is there is no excuse to anything. What you need to do, if you guys actually watch this all the way through, only thing that you guys need to go ahead and do now is just replicate this same thing over and over and over and over and over again. That's all you need to fucking do. Thank you guys for staying on for however long this video is taking. Messed up. I will go ahead and edit this video so that way it's in different chops and different portions. But all together, I love you. Stay positive. Stay true to yourself.